Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's call. Before we get started, and perfect, you guys are on top of things. Looks like everything is good to go. We'll go ahead and get started. Welcome to today's call. And today we're going to be covering quite a bit of ground. And I think last week was an interesting week for some of the members on here. It was probably their first time to actually really experience the, I'm not going to call it, well, yeah, the dead zone. And the warning that I give about giving yourself a lot of extra room when the market moves up into these dead zones. So we'll be covering that a little bit today. We're going to be talking about the bullish trades today, and as well as structuring these in a little bit lower risk fashion from the standpoint of the dead zone. Obviously, we couldn't get any lower risk last week from regard to the market dropping down or moving higher. We had unlimited profit potential to the upside in some of these trades. We had no risk to the downside, but the risk was in the dead zone. So we'll be talking about structuring these a little bit differently. If you want to bring the dead zone, or you want to diminish the role that the dead zone will play in these types of trades. So we'll cover that pretty extensively. Before we get into everything, obviously, again, the seminar is coming up quickly, and this seminar is going to be at the end of the month, July 31st and August 1st, online, live, and it will be covering everything you can imagine with this approach. And we probably won't be able to cover everything, but if there's anything that's left over after the seminar, and I cover it in a future presentation, any seminar person gets access to all of that. So again, that's coming up. If you have not renewed, you need to renew to be able to get into that at the subscriber price. The yearly subscriber gets a discount. Okay. For those that are new on the call, welcome to today's call. I do want to caution you, I do not explain everything about these trades on the call. I'm having the seminar July 31st through August 1st, and that's where I will cover everything. And obviously, it's impossible for me to cover everything. If I'm doing a 2-day seminar, it's impossible for me to cover everything in a single call, especially when we're talking about what opportunities exist right now in the markets, because we go through that, obviously. So just be prepared. This is not designed for beginners, but I do want to give everyone who is considering coming on board at least a taste of what the live calls are like. And if you are new, if you're brand new to the subscription, you just renewed or you just became a new subscriber, these trades are fantastic, and they will absolutely give you the ability to achieve the goal that we discuss in this call. Absolutely, no question, hands down, we'll do that, but you have to start small. And if you don't start small and you don't understand everything, something will come back and bite you in the butt. I promise you. You need to be very careful with how you structure these trades, as the basic logic is very, very sound. It's very, very straightforward. Anyone and everyone can understand it. However, the actual execution of the trades need to be very, very precise. And so you don't want to be reckless, just throwing, oh, this bearish trade looks great and this bullish trade looks great, so let's just throw it together and that's all you consider. It's not that. Unfortunately, it's not that simple. The logic is, though, and so all you have to do is make sure that you go back to the logic when you're putting these together, and then of course follow the instructions. Even when I don't follow the instructions, my own instructions, it comes back and it bites me on the butt. So you want to follow the instructions. Now, why should you start off small? And some of you who didn't follow instructions, who started off big and didn't realize the dead zone was what I said it was. You might be saying, okay, now I realize I need to start small. Here's what happens many times. So for those who have ears, let them hear. People don't start small. They start big. They make the mistakes. They realize, oh, I need to do this a little differently. I made mistakes. So now I'll start small. And here's what happens. Somebody with a $100,000 account comes in, they make 15, 20, 30 of these trades on at one time. They realize afterwards that they made a mistake or they didn't account for the risk properly or whatever the case. And all of a sudden, because they traded so big, they lost $5,000, $6,000, $7,000. And so now, after they make the mistake, they go back, and I'm telling you, this happens again and again and again. After they make the mistake, they go back and they say, oh, well, now I need to start small. And they start with one lot. And guess what? They are in the hole. And it's going to take them a while to get out of that hole. So don't do it. Make sure when you get the hang of this, and you will, I promise you, when you get the hang of this, it will absolutely pay off in the long run by following this money management plan. You start small, you have lots of room to grow, and you can grow your account very quickly after you begin to get the hang of this. Okay, so this is after 6 months. If you can average just $100 a week after 6 months, then you can grow your account by as much as $30,000 in that 6-month period. If you don't average $100, let's say you only average $50 a week, you're still tripling your account, tripling, quadrupling, maybe even a little bit more, depending on where you are at around that $50 level. So start small. Mistakes are going to be made small, and then that will allow you to get in the rhythm. And as you prove that you are doing it correctly and you are taking the proper trades as you should, et cetera, then you can increase your trade size based on the actual value of your account increasing. All right, then if you follow that along, this is why I say just, even if you make mistakes, so what? Move on. This is a long-term deal. This is something that you're going to want to apply for maybe the rest of your life. And if you do it for the next 5 years and you can average just $100 a week, then you can grow your account to over $3 million. And it's pure math. It's not an if, and, or but. It is a math. Equation. Okay, so that's why you want to stick to it, even if you've made a couple of mistakes. Now, I get I get questions about a lot of the stuff that we cover, and a lot of times they're repeat questions. But one of the questions that I get sometimes is somebody who is struggling with the approach. And by the way, you don't have to necessarily make a mistake to lose money, right? This is not a no-risk situation. And there are ways to create no-risk situations, but in order to create those no-risk situations, you have to first take a risk, right? So one of the things that I get is, hey, I'm struggling, I'm not making money, and I have made a few mistakes, but then, I placed on one of these trades perfectly and I lost money that week, and, whatever the case is. All right. So you're not making ground the way that you should, or the way that you want to. Sometimes should and want to are not necessarily the same things, but nonetheless, one of the things that you need to do is, if you're in that boat, you need to step back and simplify. Step back and simplify. Okay. So what do I mean by that? Well, basically all you need to obliterate the 7-year return of the best performing stock on the face of the planet over the last 7 years, which was Netflix. In order to beat that return, all you have to do is average $10 a week. That's it. Now, I know a lot of you see these numbers here on the screen, $3 million, and you're like, okay, I'm going to get, this is what I'm wanting to do. Listen, greed will blind you, and and this isn't necessarily greedy. Having a plan to reach $3 million is not greed. It's a plan. The execution of that might be from greed, right? In other words, we want to get to $3 million next week, not in 5 years. And so we try and make $500 this week. And when I say next week, obviously, I mean 2 weeks from now. But my point being is sometimes it's made more complicated than it really is, because there are many, 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 many times where you can just put on a trade, put on one of these low risk trades and exit for a $20 target. I mean, literally simple as that, and you're done for the week. Put on one of these trades, exit at a $20 target, and you're done for the week. You know how often if you put on a high probability trade, you know how often you can do that? It's like really, really often. Okay. In fact, I'm running a contest, and I've been a little bit slow the last couple of 3 weeks, and I'm almost thinking to myself that on some of these trades, I may just stick a $50 target in, and then take the profit, and then adjust the trade during the week. In other words, put on a new trade based on new strikes wherever the market is, and do the same thing. That might be one of the better ways to go about, because I have to, in order to beat the record, I have to do about $200 a week based on a single lot. And so the last several weeks have not offered that opportunity based on how these trades have worked out in that particular account. But there's something simplistic about just saying, okay, if I want to average $10 a week, I'm going to go for a $20 target or a $30 target. If I want to average $20 a week, then I'll go for a $50 target, a $60 target, something like that on some of these high probability low risk trades. If you're trying to hang on to these for the very most maximum possible profit that is available at the very last second, you're not going to achieve that very often, because the profit peaks, in order to achieve the max profit, the market has to close at a profit peak, right? And how often is the market going to close exactly at a profit peak? It's not often. So you have to be really precise in order to do that. So I think some are trying to be a little bit precise on this. Some are trying to maybe make more than a lot more than is necessary to do really well. So just take a step back, simplify it, and that's my suggestion. Now, when I say a target, let me show you something, because I've mentioned this several times over the last several months, actually, about these bullish side, the bullish side of our trades. That when the market goes through the profit zone or into a profit surge, if you will, that you need to exit the bullish trade, the way that we set them up generally, and some of the patterns that we talk about. We need to go ahead and exit the bullish trades at that time. And on Thursday, we saw, of course, the economic reports come out, and the market surged, and our bullish trade surged. And if you've been on some of these calls, I take a lot of these trades. In fact, if you see it on here, if you see it on my screen, I've taken it. And so I was in every single one of the bullish trades that I listed. There's probably 6 or 7 different ones that I was involved that we talked about over the last couple of calls. And every single one of them surged on Thursday morning after the market surged and the economic report came out. And then things settled down, and immediately those bullish trades went bye-bye. And so here is the spread. This is a chart of the spread, and this is one of them that we were in. And I know you probably can't see the right side of that price chart, but I'll tell you what the high was. I'll tell you what the low was. And this is a 5-minute chart. So the surge that you see right here was on Thursday morning. And the surge of this particular one, this is a short 317 and a 324, and then long 2 of the 319 calls. And I forget exactly what we were long this from, but it's irrelevant. The point is that this thing surged. And when it surges, that's when you want to get out of the bullish. And so this particular one, the high price of the surge was about 107. Okay, 107. This is one of the cheaper ones that we got into. You can see a couple of days before this, when the market was trading lower, this was on Tuesday, and this particular spread was trading as low as 20 cents at one point during the day, a little bit higher. The average was around 25 cents. So this bullish trade at 25 cents surges to $1.05. It's 300% on the market move. This is not one of the better ones. It's not one of the. It's not necessarily a bad one, but it wasn't one of the better ones. Here's one. This is a 315, 320 call, so this is lower, right? And then long 2, 316 calls. And you can see here that this one surged, and the high point of this surge was at 245. Okay, 245 was the high point of this surge. A couple of days before, you can see, and again, I don't remember what exactly the buy point was of this one. It doesn't matter. The point is that it surged on Thursday. And on Tuesday, as you can see, when the market wasn't trading quite that high, it was trading at around 50 cents. And I think that's about where we got into this one, 50, 55 cents, somewhere around there. And it surges to 245. And then most of these were in 2 of them, right? And so when one surges to $1.05, that means we have it's worth $210. If this one surges to 245, that means we have basically almost $500 there at that point of value, which means that if the market comes back down, which it did, and then especially at the end of the day, most of that profit evaporates because we're in the middle of the dead zone here. The market was trading at above 315 on this surge. And so that's right in the middle of the profit zone, or not, it's at the beginning of the profit peak, I should say. And so we had a nice surge. Here's another one, 315, 321, and then long 2, 317 calls. Okay, so the calls are a little bit further away from the first short, so that's not going to be priced as much. But again, you can see here earlier in the week, we're talking about a bullish trade that was cost through 30 to 35 cents. And the high peak of this surge here was about 155. Okay, so again, when it surges, that's when you want to take your money. Now, this is the worst performing one if you did nothing with it. And this one, when we placed on this particular trade, the market was way down. And so for the market to come up through this was pretty impressive. But you'll see here that this particular one, the surge, the max surge was about 150 is where this one came in at. And this one is missing a leg, right? And we were short 1, 311 call and long 2, 314 calls. Why was I in this 1 to 2? And I'll do this from time to time, but you need to know why I will do it, and you need to know what you need to do when the market surges in this particular situation. Okay, so with this one, it was a 2 to 1, and what's it missing? It's missing this third leg, this short leg. So it's short 1 and long 2, and then as you see most of these, they're short another one. Well, this one was only short 1 and long 2. It didn't have a third short, and the reason it didn't have a third short is because we couldn't bring any money in on it at the time that we placed this trade. But just simply because we couldn't bring any money on it at the time we placed the trade does not mean that we can't bring any money on it later. And so, for example, 317 calls, which we could not bring a penny in for hardly at the time that we played this thing, I was able to bring in 45 cents on a 317 call on this particular one on Friday, and increase that profit potential significantly at that point. There were others where I sold a 315 call or a 316 call and brought in significant premium, $1.25 on the 315 calls, I believe. And so you can literally add this third leg anytime during the trade. Now, preferably, I like to exit the bullish trade on the surge, but in this case, the surge wasn't that big, right? You can see here again, a couple of days before, this was trading at a 55-cent debit, and it only surged to about $1.50. Now that $1.50 is, that's still $100 profit per one of these. So if you're in two short, long 4, that's $100 profit. But if I'm then able to sell the 317, for example, for 45 a piece, that's another $100 that I bring in at 314. If I do a 315. If it's the last day, you got to be really careful on that, but I'll talk about that here in a minute. Then, you can bring in even more on this particular trade. So there's always something you can do. And on this one, 311 calls, 311, 314 calls are pretty significant. This one here is, I believe, nope, that's not it. I thought I had the 308s. I thought I had the 308s, 311s here, and I guess I don't. But the 308s, 311s also surged dramatically because those were 1 to 2 as well. I had 1 308, short 1 308, 2 long 311s, and those performed very well. They opened up at significant profits on Thursday, and I exited those for a significant gain, and then I got out of my bearish trade. Okay, so that's the first thing that I wanted to cover today is with regard to the bullish trade is you want to get out on the surge. The second thing is how we structured last week's trades. A little bit different than I had done it previously, and the reason I did it differently is because I didn't want any risk to the upside from the standpoint of the market surging and the maximum risk. What happens to the trade if the market skyrockets and we're in the minimum profit zone, I should say, or maximum risk zone to the upside? And so what I want to do is I want to show you a couple of things that that I've done. So let's pull this one over real quick. It will, there we go. All right, so here I was filled on this morning. It is a 316, 319, and two 320s. Okay, filled on this at a $1.55 credit, and I'll show you that. There it is. Filled on a $1.55 credit filled. Okay, so that was filled. That's this trade. Again, a 316, 319, and two long 320s. It's very similar to what we've done with regard to the bearish trades. With the market higher, I am not quite as concerned about getting filled on a lower risk trade first. Again, if you can't take the risk of the bearish trade, then you still need to do that. You need to take the lower risk trade first if you have a smaller account. And the risk on this trade, even though it's way up there, the risk on the trade is about $345. Obviously, my intention is to put a bullish trade on this, but there's never any guarantee that you'll get filled on a bullish trade. I'm not filled on this particular bullish trade just yet because I'm waiting for an even better price. I could easily get filled on a bullish trade right now, but I'm waiting for a better price. And right now, this trade is only trading at a credit of 125. Okay, so in other words, I am making $30 on this trade right now, and I put it on this morning. So here's a question. If I put on this trade and I'm making $30, what's to prevent me from just getting out, taking $30 and being done for the week? It doesn't, there's nothing wrong with that. Except for the fact that if you take $30 on a trade like this, eventually you are going to realize the risk if you don't get filled on a bullish, right? So you've got an opportunity. If I'm not filled on my bullish and I have $30 of profit, maybe I don't get into the bullish and I just take my $30 of profit and I adjust. Get into another trade, get into a bullish trade first, and then into another bearish trade at different strikes. Something like that. Nonetheless, that's the bearish trade. Okay. If I were to put the bullish trade on as is that I was looking at, this is the bullish trade, and this is a 323, 325, 323, as you can see here. So this is one of the typical ones that we've done, where I'm short 2, and then my long is equal to my lowest short. Okay. And so 2 different legs, and then my single long is equal to my my lowest strike short. And that's going to give me a debit of 89. And with that particular situation, because the strike difference is $2, then that means my minimum gain to the upside is $111. Right now, I could have put on 2 of those at the same exact time that I put on this bearish this morning, okay, at 155. But I would have had a debit of 23 cents. This is the combined. And this is a debit of 23, which means that there is risk to the downside if I were to have done that. $23 maximum risk to the downside if the market tanked. And I've already taken volatility out of these. So this is a very realistic graph right here. I've lowered the volatility in both my longs, my 320s and my 323s significantly. But the purpose here is not to hang on to this trade for a $300 profit. And I think that's maybe a misconception that some of you are saying that, hey, I'm hoping to make $300 on this particular trade. And especially if the market moves up into that range. And that's not the case. The reason that I structure this is to take profits in this profit zone if they are available. So if the market moves up into this profit zone, I want to take profits in that profit zone. Almost always. There are times, every now and again, where the market will open up past the profit zone. You may not have that opportunity. In which case, this particular graph goes out to 330 because of how this particular trade is set up. The max risk is less than $100. You accept the max risk. Simple as that, right? I didn't want to put this trade on at a debit though, and this of course has the bullish. It's two bullish trades to one bearish neutral trade. And again, the bearish neutral is bearish neutral because the market can still go up, and this trade will make money. Break even will be probably around 320, and so that gives you that ability, right? So one of the things that is different with this structure than last week is that I structured it a little bit differently so that there was no risk to the upside if the market surged. When I say no risk to the upside, of course, I'm accepting the dead zone risk. I'm talking about once the market gets past all the dead zones and we're out where everything is has no extrinsic value whatsoever, we still were not risking anything to the upside last week. That's not one of my favorite trades because if you're willing to take a little risk to the upside, you can create a scenario where the dead zone is not near as looming, I should say. So this is, again, the structure that you can put on together at the same time. This was available on Thursday. I sent out a signal on Thursday. I was actually filled on a couple of those trades based on the signal I put out on Thursday. I had obviously placed a couple before the signal was sent out. Then after the signal was sent out, and I mentioned in the commentary that you might have to adjust the trades if the market moves away, or adjust the prices if the market moves away, but just go for that 5-cent credit. And if you did that, you were probably filled. A couple of times I was. And so with this particular trade, I'm able to pull the bullish closer to my bearish because I'm willing to pay a little bit more for it, and I'm willing to take a little bit more risk to the upside. And so we were able to get into those for a 5-cent credit. I'm also going into this one, waiting to get into this one for a 5-cent credit. And if I'm filled, which my bullish side is still not filled yet, but if I'm filled on my bullish side, then I will have no risk to the downside. I've already taken quite a bit of volatility out of these longs. And if the market surges to the upside, then I will be able to take profit out of that particular trade. All right, so this is a standard thing that you can do that we've been talking about and we've done several times over the past several weeks, okay? Then there's one other thing that you can do. If the market is higher, and I actually prefer this when the market is trading higher, but you have to be willing to take the larger risk in the scenario, and that is take a trade that has a little bit more, take a bullish trade that actually still has risk to the upside. It's not something that I necessarily think everyone should do at the beginning, but it is something that can be done. And what that does is that creates a scenario where the market goes through the bullish side, and there's actually more bullish potential with it because you're paying less money. But you're paying less money. But in order to pay less money, it means that you're actually creating more risk to the upside. So take a look at this trade, for example, right here. This is a bullish trade. It's 324, 327 are the shorts, and then it's long two 326s. And you know that there's risk to the upside because the strike difference is not negative, it's actually positive. If you look at this, it's 324, 326, that's 2, and then a 326, 327, that's -1, so the whole thing is a 1-point strike difference, positive. Plus there's a debit, which means that your risk to the upside is $125, okay? But what you have is you have a much stronger surge with this particular type of scenario. But I'm going to, before you go rush and putting any of these on, let me explain something else to you as well, okay? Now this one is a debit of 25 cents. Right now, the bullish trade that I'm trying to get filled in is at, I'm trying to get filled at 75 cents. And the bullish trade that I'm trying to get filled at 75 cents is this one. And that's a 323, 325, 323, two 323s. All right, this is the bullish trade I'm trying to get filled at 25 cents. Look, there's a minimum gain to the upside of $125. Okay, my maximum risk to the downside, $75. It means I can do 2 of these with my $1.55 credit, bearish trade, and I have no risk to the downside. That's how that works, right? My 2 bullish trades are risking $150. My bearish trade is guaranteed to make $155. That means I'm going to make minimum $5 on that trade. So on this particular trade, the surge will absolutely happen. And it will absolutely happen because my minimum gain is actually bigger than my risk on this trade. Okay. The downside is that I'm paying more money for it. All right. So I can only do 2. Right. But if I put a trade on like this, if I put a trade on like this and I have 25 cents, how many of those can I put on for my bearish trade and maintain a credit? I can put on 6 of them. But if I do that, look at how much risk I'm taking, right? So that's the drawback. So you can move over here to something that's closer to this, and you might be a little bit better. And this is a 325, 327, 329. So the strike distance is 0. The net strike distance between the longs and the shorts is 0, which means that my risk to the downside is going to be the debit, and that's also going to be my risk to the upside. The strikes are very close together. There's not going to be a dead zone here. The only question is how much of that will actually be a profit. And so in this particular situation, let's just create a bigger graph so you can see a bigger illustration of this. In this particular situation, the profit projection on 1 is at 200. It's not going to be 200. We all know that because the market's going to come up. The longs, the shorts, or excuse me, the long is not going to be worth as much as this is saying. It's probably going to be closer to maybe 150. But how many of these can you put on? Right, 27-cent debit. You can do almost 6 of these. And as long as you are able to pull out of them at if the market goes into the profit zone, you have a huge probability of success. The problem, though, again, is the risk. Okay, now it's only $27. If you get filled at $27, it's only $27 to the upside, but it's on top of the $350 risk that is currently on this bearish, right? If I'm doing it in combination with this particular bearish, then I'm adding risk to my trade to the upside eventually. And it's going to be way up there, like at around 335. And so for me, if you'll take a look at this again, you'll notice that the profit peak here, the second profit peak is at 329. What's the probability of the market going to 329 by this Friday based on the surge that we've seen over the last week. It's very low. Not going to eat my hat if it does it. Not going to say it's impossible, but even if it does, that's a profit peak on this. And so we'll be in the middle of the profit zone on this trade. And so if I wanted to, I can put this together with maybe a trade that has less risk to the downside, a bearish that has less risk to the to the upside, excuse me. Maybe not going to give me as much of a credit, but I don't need as much of a credit with a bullish trade quite like this. All right, but nonetheless, let's put this one together. It's a 325, 329. Let's see, sell, and we're going to do it on a new graph. And I know this isn't 329, but I will change that up here, and then 327s. And again, that's not showing. I can just change it up here. If I wanted to, I could say show me more strikes, but that's a lot of scrolling. So I'd rather just do this. 7. And then I'm going to do 2 of these, right? And then on that second short, it's actually 329. And I'll get to that here in a second because I wouldn't actually place on this trade, and I'll tell you why here in a second. But nonetheless, I'm going to do that. And then I'll update the last one as well. All right, so this one is showing, whoops, I said 3. It's actually 2. All right, so here it is, 26-cent debit. How many can we do? We can actually do as many as 6 if we wanted to on this particular trade. I'm going to do 4. And remember, the more longs you have, the more money, or the more room you have to give it to move. All right. So we'll do 4 of these. Total cost is $104 debit. And what we will do is we will add it, or we will add my bearish trade to this fairly bullish scenario. All right, so I'll just move that to 8, move this leg to 8, and then move this leg to 8. All right, and then we'll go here. Make sure it's all there. All right, so here we have a scenario, and I'm going to go 335 just to bring it down. We have a scenario where I have a 51-cent credit, and that means that my minimum gain to the upside is 50 cents. Let's see if it'll update here. Okay, now again, this is not necessarily something I'm suggesting everybody run out and do. What I'm putting together here is a scenario where you might consider something that is cheaper in order to produce a bit of a better risk scenario. Okay, now there are several problems with this. Again, this is 8 longs, and if I give $50 per long minimum, $50 per long minimum, that's $400. Okay, but that's holding on until the end of the trade. All right, so in this particular situation, this profit peak, this second profit peak, is actually less than the first profit peak in that bullish trade. And so this is one where I do not want to hold on to this type of trade until the end. What I would rather do is take a profit if one is afforded. And so what I want to do is I want to show you something. Again, I'm just throwing these together. This is not the best one. This is not necessarily, if I were to do this, this is not necessarily the one that I would do. I'm going through a process to make a point. All right, so here is a watch list of some of these trades. And the one that I am showing you, which is a 321, nope, that's not it. Where is it? 325, 327, 329. So still trading at about a debit of 26 right now. And you can put on this trade right now if you want to. However, I would not do that. I would not put on this trade the way it is. And why would I not put this trade on the way it is? Because I can only bring in 8 cents on the 329. And hopefully everybody can see that, the number here. The 329 call, which is one of my short legs, is only going for 8 cents. Why in the world would I do that? Well, I'm not going to do that, right? So if I were to move that out of the trade, then I'd be left with a 1-2. Remember? Left with a 1-2, but with the intention of selling that third leg at something better than 8 stinking cents. And here's a thought. If I sell this leg for the debit, which is 33 cents, right? So if I put an order in for 329 and sell that leg for 33 cents and it's filled, guess what I have? I have a no risk bullish trade. No risk bullish trade. So what would the market have to do in order to be able for me to sell the 329 for 33 cents? I'll tell you what would have to happen. The market would have to go up through this dead zone, or not dead zone, the profit zone. And then I have a choice. I can either exit or I can sell the 329 and create a no risk bullish trade. Now, if I create the no risk bullish trade, that means that I still have risk on my bearish side of it if the market were to continue going up. But that's how you would create a no risk trade, is by just simply waiting to sell that next leg for 329. Of course, because I do have a bearish in here, I don't need to worry about selling that particular scenario, right? All right, so back to this page where I'm not going to sell the 329s. All right, so whoops, 08. Sorry, let me rephrase that. 0. So I'm going to bring this down here. And then I'm going to click on that. All right, so this is without selling the 329s. And I want to bring this back down to 330 so there's a better perspective here. And maybe it will update. All right, so now this is what it looks like, okay? You'll notice I have a sag here. I have a dead zone here. If we're getting it into Thursday, Friday, somewhere around there, and I'm in this dead zone, I'm going to be looking to sell something, because there I have no risk. If I get to Thursday and the market, I shouldn't say no risk. I'll shut my mouth on that one. If I get to Thursday and the market's trading at 320, 321, the risk of it going to 335, 336 on Friday is so utterly ridiculous sufficiently small that I definitely do not care about whether I'm going to make a lot of money at that point, because I have unlimited risk here, or unlimited profit potential, because I am open. I have a bunch of extra longs, right? I have 327s. I have a bunch of extra longs. So what I'm going to do is I'm going to do something to bring up this dead zone. And even though it's a long way away from my all of my longs, and I've got this profit peak here, I still would be concerned about this dead zone because it's only at $103. And it's not that big, it's not that much risk in the dead zone, because you have this huge profit peak here that is beyond the dead zone, but it's still something that can definitely lag based on however much those 327s are worth, which there's not a lot that they can be worth. In this particular situation, it's showing that the 327s, I'm in 8, are going to be worth, let's see, that's 24 cents. It's showing that the 327s are going to be worth maybe 30 cents. If the market moves up to 321, 322, those 327s are going to be worth 30 cents. Well, they're probably not going to be worth 30 cents. They might be worth 20 cents, as an example. And so that's why I'm not as concerned in this particular scenario, because those longs can't go, they can't go less than 0, right? And so if I'm below these longs, the projection here is that they're going to lose money at 321. Well, they can only lose 35 cents a piece. So I don't have to give it $50 per long in this particular scenario, because the entire value of the long is less than $50, and the projection is less than $50. The projection is only about $30. So that's something that it doesn't concern me quite as much. But if the market moves up there, I have all these extra longs. I can sell something probably for a little bit more money, and just one of them, right? And this is what is available to you once you get the hang of what these graphs are telling you. So if I can do anything where that's going to make money above 322, or excuse me, below 322, I may drop this profit peak down by doing that a little bit, but it's not going to be a lot, and I've still got a lot of extra longs here. And so what I would be looking for is, I would be looking for, hey, okay, let's say the market gives up to 322, 321, 322, and it's Thursday. I may either exit the entire trade, or I may try and sell, let's say, a 323 put, or excuse me, call. Oops, and I need to move that up. So I'll move that back up there, and I may try and sell it for $1. Okay, that's going to give me another $1 to the downside. I'm going to have a total credit on the trade of $111. Now I've got a $200 gain here, and I still have a massive profit peak. Now I've created this massive dead zone here that absolutely will cause me concern if the market goes all the way up to 328. But for me, it's worth taking the risk. Okay, so there's the process, there's the thought process of going through here and saying, okay, what do I do in the dead zone? What can I do to diminish the risks in the dead zone, et cetera, et cetera. And that's just a couple of different things that can be done. All right, so let's take a look at some of the bullish trades that are available. And I'm going to go ahead and do a refresh so we get the latest, most up-to-date prices on these before we go down that route. So it's going to take just a second for it to update. All right. So we'll go 710. And then I will sort by credit and then compare the risk graphs. All right, I'm not going to worry about any of these that have these huge risks to the upside if the market absolutely skyrockets. Although these trades, have a high probability of making a little bit of money, but huge risk to the upside. All right. So here are a couple of different opportunities. The bullish trades that have minimum gains to the upside, like this one right here, it's a 19-cent debit. What's wrong with this particular trade? What's wrong is the distance between the two shorts. That's what's wrong. 324, 331. That distance is 7 points, and that creates a dead zone within the bullish trade itself. Those are the ones I don't necessarily like. But again, what else is wrong with this trade? The 331 only going to bring in 5 cents. Hopefully you can see that. It's only going to bring in 5 cents, so I wouldn't even do that one. I might consider the 324, 327, but I like the longs to be closer to the shorts if I can get them for a decent price. So let's just keep scrolling here. These are all really cheap, very, very cheap, that have these profit peaks or profit zones that are to the upside. So again, here's a 321, 324, 327. Here the shorts are 5 points apart. So you still have this dead zone here that's $100. That means that could actually go and be a loss in the middle of the dead zone because there are 2 longs with that. 24 cents though, if it's going through that area and you have an opportunity to take the profit, I would do that. Here you can see where the short strikes are really close together. There is no dead zone that has any risk of dropping below zero. None, zero, none whatsoever. No risk of that happening. What you do have a risk of happening is the market continuing to the upside, and eventually you would suffer a $125 loss. With this one, this is a 24 cent. So this one's 325, 327, 328. So the 327s are the 2 longs, and then the 2 shorts are 325 and 328. Okay, we'll just keep scrolling just to take a look at the price and what's available. Okay, so here's a good one. 325, 327. Again, here's the short of 329. So this is exactly what we were looking at, only a little bit different where the short is. Excuse me, a 330 short, not a 329. 330 short. But this again is just basically a 2-to-1. So I've got 2 327s and 1 325, and I'm just going to be looking to sell something up there once the market moves. I actually would not sell the 330 on that one. And again, that one's only going to be about 35 cents. Here is a 323, 325, and then 326. And I'm bringing in 21 cents on the 326, but there's risk to the upside. So that's something that you might want to consider. Again, this is just because you're selling at 331. At this middle one here is selling at 331 at 5 cents. I wouldn't do that. It would be, again, 325, 327. Here's the 324, 326. That is a little bit closer, so your profit peak is a little bit closer. And so 325, by the way, the closer the short strike, the sooner it's going to be making money, which is very important. That's how you structure these, right? Yeah, where do I want, if I'm in this bearish trade and I'm in from a $1.55, which I am, and it's still trading at a $1.25. But if I'm in this bearish trade from a $1.55 and I put in a bullish trade, where do I want that bullish trade to start making money? At minimum, I want it to start making money at 320. If I can have a profit peak that's really close to 320, let's say maybe 321, 322, then that's even better because it brings that whole dead zone up. So the closer you get those short strikes, the better. So for example, on this one, this profit peak, this is a 321 short strike and a 324. So the first profit peak is 321. And then you have a 322 here. Again, it's only 34-cent debit, but there is risk to the upside, so I'd be very careful with that particular one. Just gonna keep loading here if it will load. It'll load here in a sec. There we go. Here's 325, 323, 325s with a 327. In the 327, I can bring in 16 cents. That'll give me 35 cents on the entire thing. If I wanted to, I could again just do this as a 2-to-1 and just be willing to pay 50 cents for it. And I could do 3 of those at that point, right? I could do 3 of those compared and still have a credit on my bearish. So here's the 325, 327. This is a 1-2 and it's trading for 33 cents. If I go with a, did I duplicate that? If I go with a 321, 323, I can actually do 2 of those right now. 321, 323s with 2 323s. And I can do 2 of those for about the same price as what I'm trying to bring in on my current bullish trade, which is 323, 325, 323. So that's certainly something that is doable if I absolutely wanted to, because I can always choose to sell a 325 call for the debit if I want to wait for it to go up to 74 cents, for example. I could sell the 325 call for a debit, or excuse me, for 75 cents, and I create a 0 debit trade on this, so no cost. And it would be a very bullish trade between 321 and 323. So here is, again, just moving this up one if I want to pay a little bit less, because I don't have to have a 321 profit peak. I just want it to start making money by 321. And you'll notice here that if I do a 322, 324, it'll update here in a second, versus a 321, 323, it's trading for 59 cents. And so that profit peak is a little bit further to the upside, but if we plug it in, let's see here. Here is, whoops, that's not the one I had open. Where's the one I had open? Hang on. There it is. We do the 1-2s, the 2 1s. So I'm going to add one to 322, sell to 9, and then the 324s buy. And we'll add that to 9. We'll go 2. All right, so that one is going for about 59 cents right now. And by the way, all of these are, the market's coming down just a bit. So these are actually getting better priced as we speak. So it's actually 59-cent debit right now. We're gonna end this at 3:30 so that we can get a little bit better perspective on it. Maybe if it'll update. All right. There we go. So this is projected to start making money long before 322. At 320, it's projected to make about $81. Okay. And that's if you hold on. As of right now, at 320, this bearish trade is projected to make about $93. It's probably going to be closer to a break even if we held on to the very end, the absolute last minute. And so my bullish trade would be making a little bit of money. And you'll recall, because this is only going for 61 cents, I'm actually going to be doing 2 of them, or I would do 2 of them. And it will update here. I really need to have them put the save changes button on by each graph, but nonetheless. So on 2 of them at 320, we're talking about, it says $162. It's probably going to be closer to like 125. And so that's something, like right now, I have this working. I'm in at 155. I have my bullish trade 323, 325, 323 working for 86 cents, or it's at 86 cents. I have the order in place at 75. Before the end of the day, if I wanted to get into a bullish, if I didn't want to hold on to this, especially since I have a profit on this trade, I may just go ahead and do a couple of 321, 323s. And what can I get the 321, 323s for? I can get a couple of those for 75 cents, right? So if one bullish trade is not getting filled, you can always look for a different one, and that's kind of the process of going through that. And so these bullish trades, again, are being put together, hopefully closer to where your short strikes are on your bearish. The closer, the better. And then take the profit on the surge. Okay. All right. Let's go ahead and take questions. All right, anytime I look at a profit projection graph, I need to always subtract $50 from long across the trade breadth. Aaron, yes and no, as I mentioned here in this particular trade scenario. Where is it? Where there it is, where the longs are only 35 cents, right? In this particular scenario, the longs are only 35 cents. I do not need to subtract 50 cents when those are out of the money from the entire breadth of the trade, because they're only worth 35 cents, right? So it's when those it's when those longs are projected to be worth something more than 50 cents. That's when you have to be careful about that. And obviously, the higher it's projected, the more you need to be concerned about that. If you close the bearish spread early for a profit equal to what you paid for the bullish spread, is that a good move? Yes. Yes, it is, because you create a risk-free trade and absolute guaranteed risk-free trade as long as the dead zone is not spread apart. Right? You don't have the bullish trade that has just this super wide distance between the short strikes. Let's see here. Why did the risk graph show a loss across all the trades last week, including before and after the dead zone? So the deal with the volatility, it's a strange thing. that you just have to get used to, because there's no getting around it. Is that when the market is up, the volatility in the longs is going to drop out, right? But that's not going to be the case if the market is in your profit zone well before the dead zone. The value of the longs are not going to drop out as much because they're not worth as much. Yet the graph shows it will, as if they were to drop out, and so it's just not. It's not accurate from that standpoint. So yes, if the market would have moved down into your profit zone before the dead zone, you would absolutely have made money. There's no issue there. Do we exit Friday expiration bearish trades today and keep the bullish trade? You can if you want. I wouldn't do it. So for example, if I were already filled on this bearish, on this bullish, you know, obviously I have a scenario in this particular trade where the total cost of the bearish is my bullish. So I would, or the total credit, I should say. Meaning if I were to exit this right now and I had these two bullish trades on, let's say I had them on at from 75 cents and I exit this at a $25 profit, that means I have risk of $125. Or at, excuse me, if I exit this at a $25 profit or a $30 profit, I have risk for the value of my bullish trade at that point, minus whatever it is profit that I took. So you can only do that if you have quite a bit of credit to work with. Will the new version of PDS Trader make it easier to see how to combine two trades in one risk graph to see volatility crush scenarios? Yes, as a matter of fact, it does it for you. So right now, when we do the trade finders, it only allows 4 legs. Because that's the minimum, obviously, or the maximum for a trade order. But for research analysis purposes, we're going to have it to where they show risk graphs actually combining the bullish and the bearish. Let's see. Be careful of forcing the trade to pay you at the very end. That's exactly what I was talking about. Exactly. You don't want to force the trade to pay you at the end. That's a very good way of putting it. Let's see here. Great advice. If time to get out of the bullish trade is in a surge, is that also a good time to close out the bearish trade? So I covered this in the last call, and I'll cover it just really briefly here, because I did make a mistake in one of my trades on Friday because I miscalculated the risk on the trade. So I got out of a bullish trade at like a total profit of like $400 out of the bullish. And I got out of the bearish trade at like a loss of $170 or something like that. And there was only another $30 risk on the trade, on the bearish trade. And so when I got out of the bullish, I got out of the bearish thinking that I had $130 risk on the trade and not just $30 risk. And that's just me doing too much is what, so I even make mistakes on that. I absolutely should have held on to that bearish because there was only $30 risk left. Worst case scenario. And I had just taken $400 profit on my bullish. So there's no way I was giving back all my profit. And the only thing that could happen that was really detriment, that was of really any consequence, was that the market moved down and I actually take a smaller loss on my bearish. Or in one case, I actually took a profit on my bearish because the market moved down after I got out of my bullish. And so That's something that you need to be cognizant of, is how much risk is on the bearish, because if there's not that much risk left on the bearish, man, just hold on to it and see if the market doesn't come down and give you a better price. When you say get out of the bullish trade, do you mean get out of the whole thing at the surge or just the longs? Well, that was just answered by the previous question. So a couple of you thinking about the same thing. What software are you using the graph spreads? That's PDS Trader, Barry, and you should absolutely have a subscription to PDS Trader. It comes with your subscription to TPO. Can you please tell us how to get the charts of the spreads you were showing? Oh, the graphs for the spreads. Sorry, guys, I had to use IB for those. The question was about these graphs. So we are looking at better charting in Trade Partner, as I've explained previously. The graphs with regard to Trade Partner is not something that we focused on, because everybody and their dog focuses on charts and graphs, excuse me, in their trading platform. And what we wanted to focus on was what would actually help us make more money. Now that we've got most of that functionality in place, and we're adding some more to it, but we are going to be spending more time on charting, and we will be providing option charting, and not only that, but you're going to see option charting with the underlying in the background. It's something that I used to have on a software program a long time ago. We got away from it, and we're going to go back to it. Should we always exit this trade the day before a big economic reports? No. The surge in this particular trade was on Thursday. The problem with last week with the dead zone was that the economic report came out on Thursday and the markets were closed on Friday. And so all of the extrinsic value was going to come out of the longs on Thursday afternoon as opposed to Friday afternoon, which is normally when this particular economic report came out. No, I do not get out the day before the economic reports. As a matter of fact, it was this report that created the surge in the bullish trades. And so it provides opportunity. Let's see. Take profits, leverage all the time. Just scrolling through here. That was a comment, not a question. Do I ever use Smart Fill? Yes. You don't want to use it on the fly, though. You want to use Smart Fill. You want to plan your trades out on that. But yes, absolutely. We are actually making a Smart Fill template, so it's much faster to apply a Smart Fill instruction to a Trade Partner order. Maybe a better question for the seminar, so feel free to skip now. Okay, given your examples, putting on bearish neutral trade. Just let me really read through this real quick. About putting on bearish neutral trade and then staying put. Okay, so Scott, his question is, okay, why not just stick with a bearish trade, something like this? Whoops, that's not it. Where are you? Here we go. So his question is, Ryan, why not put on a bearish trade and not like this, and then not put on a bullish trade immediately, giving you a chance to make money on the bearish trade, and then when the market moves up, just add on another one of these? That is a great suggestion. The problem is that you have to account for the risk on two of these. And what if this happens? What if the market moves up? Let's say on Wednesday, you put on another one of these, and then on Thursday, nothing really happens. Maybe the market inches up and it's getting really close to your risk level. And then on Friday, the market opens up. You aren't able to add one of these on, and all of a sudden you just you just got whacked $600, $700. That's why. However, what you can do is you can plan it a little bit differently and put your bullish trade up here at around 325, 326, 327, and do a couple of those, and then plan to add the additional bearish if the market moves up even further. That is something that I have done in the past. So you create a dead zone, but you have a plan to fill in that dead zone with another trade. All right, let's see. What do we do if we've been getting trade signals? Ryan, yeah, the last trade signal came out on Thursday afternoon. It was not filled as given, which is in the commentary of that trade signal. I said, hey, if the bearish isn't trading where it needs to be trading, as long as you can get a 5-cent credit between the two, that's what I'm going for. Okay, so when reducing volatility in longs, how do you determine the value of volatility so I can do the same on a portfolio chart? So in this particular example, I base the 320. So what I do is I take a look at the last week's longs, and that's where I want to put them at. And so, for example, on this one, a 320, the 320 longs is leg 3. And I'm in 2 of them, and it's saying that I'm going to make about 15 cents a long. That's about 185. So that's pretty close to what I'll be able to get out of the longs for, as long as I don't hold on to it to the exact last minute of the trade. And so I base it off of that. So between 170 and 185 at the money long. Now that will change as the market moves even further to the upside. How do you take a $30 profit? I can place a limit order to close everything down, so I need to place 1 or more orders to close 1 to 4 legs. Okay, so my comment with regard to the $30 profit was with regard to this single trade. All right, this single trade. If I want to put the order in here, if I'm not in the bullish or whatever, maybe I'm in a bullish, but if I want to take a profit on this single trade, then I'm going to click on this button here. It's duplicate inverse. And then it's going to say buy to close, 316, buy to close, 319, buy to sell to close, 320s. If I'm in for a credit of 155, then I want to exit for a debit of 125 on a limit, and that will give me a $30 profit on that particular trade. All right. But when do we switch to using option insanity? So in Thursday's call, Christian, I'm actually going to provide a couple of option insanity trades. All right, let's see here. How do you get to Eloy, the super bullish? Hang on one second. If you look at system strategies, which is right here, you'll see 911 core trade LT super bullish. If you don't have access to that, if you don't see that in your system strategies, contact support. All right, you are welcome, Aaron. Are you saying just let a limit on the spread and take it? Troy, I'm saying that it can be that simple. I'm not saying everybody just take a small profit. That's not what I'm saying. What I'm saying is, if you're having trouble getting started, seeing your account advance, then maybe you want to simplify it and take a single high probability low risk trade and just put a target on the thing for $30. Here, let me show you something. Let's see, here it is. Yep, I did. I didn't have time to go over this today because I wanted to put it in a little bit better format, but let me show you something. All right, so here is the value of basically the bear spread that I placed. I placed on the bear spread on Friday. I think it was a 314, 317, 318. I believe that was correct. 314, 317, 318. All right, so it's the same thing as what I just showed you, only with a 316, 319, 320, because the market moved up. And this was as of the close, and the market's trading, I forget where the market was trading at the time, around 312, I think, 312.50. And so this was out of the money still, and I could bring in $1.23 credit. Well, that same 314, 317, 318 spread 1 week later is at a debit of 35 cents. All right, so this is one that it takes strong advantage of time value. I can go in the money. 310, this was in the money. 310, 313, 314, credit of 210. 1 week later, based on where it's in the money, is credit of 64 cents. So, you know, $100 and something there. You go all the way up here, go all the way into the money, and this is the first one that lost money. It's in the money by about 5 points. Okay, so if I placed it on, it was in the money at 5 points at 267 credit. It's the only one that lost money if the market went nowhere. Or that's the first one, I should say. So that's 5 points in the money at the time that you could place it on for 267 credit. If you held on to it and the market went nowhere, the following week you get out for a 288 credit. And that's a loss of about $21, as you can see right here. Okay, so even if you go in the money on these and bring in bigger credit, so for example, 308, 311, 312, credit of 248, what's the strike difference on this thing? It's 4. So my risk on this is $150, worst case scenario. And this is in the money. And if we see any movement to the downside whatsoever, I could easily take a $50, $70, $80 profit on this. If the market goes nowhere all week long, I still take about a $20 profit on that trade, even though it was in the money by well over 4 points at the time that it was placed, meaning the short strike, the lowest short strike was in the money by 4 points. So going in the money, you get bigger credits, you have lower risk, and any move down, you have a better chance of taking a profit. So you can adjust this slightly and maybe do a 308, 310, 311, and that's going to give you a smaller risk because of smaller profit potential, and do it for a credit. And I mean, literally can be that simple, and then you just wait for a bullish. But you know, obviously that's not necessarily the best thing to do. I'm just showing you that on most of these trades, if you put them on about a week in advance and then just sit on them, most of them are going to make a pretty decent profit on the trade. All right, you come up here and you're looking at, you know, 175, 195 dollars if the market's at the money at the time, which is right here. This is the prop. This column is the P&L. If you just put on the trade and sit on it. So if I put on this trade, where is it? The 155 trade. If I just put on this trade this morning and sit on it, and the market is trading at 316.50, 317, somewhere around there, next week I'm going to be making $195 to $200 on this trade. If the market goes nowhere, okay, so there's lots of room for taking profits on these trades, if that's something that you want to pursue. Let's see here. When I talk about exiting bullish trades on a surge into the profit zone, do you mean getting out of just the bullish hedge or taking off? Okay, I answered that. a couple of times. Hopefully, Steve, let me know if you're clear on that. Should we put a limit order exit in the surge? So that's a good question. So the question is, should we put a limit order to exit on the surge? And the answer is yes and no. So you have to determine what your limit is going to be, because you don't want to get out at, if the surge only produces a $50 profit and you have a $300 risk on your bearish, you don't want to get out necessarily at that point, because it just means that there's probably a lot of time and you probably have a minimum gain on the trade as well. So let's see here. I had something here that I could do. Yep. Let me show you what I mean. So here is the 325, 327. Remember the 2-to-1 ratio. Short 325 and long 2 327s. It only cost me 33 cents. If the market moves up a point, where should that be if the market moves up a point? Well, how I know where it should be is by saying, okay, where is the 324, 326s at right now? And if the market moves up a point, for example, tomorrow, and this will change here in just a second, then what I bought for 33 cents should be worth 42 cents. So literally, if you want to talk about a delta, the spread has a delta of like 10 cents. If you want to put a number on it, or 10%, if you want to put a number on it, for that spread, based on a 1-point move up tomorrow, then my spread should move up 10 cents. And if the market moves up, let's see, 4 points, then my 33-cent debit should be worth 75 cents, right? So now granted, this 75 cents is still out of the money, right? Because the market's only trading at 316. So this is 5 points out of the money. If I want to take a look at this and say, okay, what if the market shoots up and all of a sudden it's in the money? My shorts are at the money, let's say at the money. Then what will my call spread be worth? And you'll see here it's $2. So it went from, so if the market moves up not three. If the market moves up enough to where my shorts are at the money, then this is the expected profit that I should be holding. And so if I put a target in, I got to make sure that it's enough to offset my risk on my bearish, or a lot of my risk on my bearish. And in this case, obviously it would, because I would be making about $170, $160 on this trade. And so I could actually put a profit target in, and that's each, by the way, that's each. And so I could actually get out of both of them for about a $350 profit and completely do away with my risk at that point. And at that point, I wouldn't worry about selling another option. So I would take a look at that based on the prices of, if my bullish goes at the money, just recreate the bullish trade based on the strikes being at the money right now. You mentioned last session that you will talk about expiration dates close between them. I'm not mentioned last session that you will talk about expiration dates close between them. I guess I'm not following what I said I was talking about. If you can jog my memory some other way there, All right, so when you say to close the bullish trade, do you mean both longs and short spreads? Okay, I answered that. Answered that. Ryan, if you trade in the dead zone and you close it Thursday afternoon or Friday morning, do you figure less than $50 volatility loss by closing early? If so, how much? DJ, yes, but the problem is that my shorts also have some extrinsic value. And so what I say is, listen, if you get to Thursday afternoon or Friday morning and you're in the middle of a dead zone and you have a profit, take it. Get out of the entire trade, or if you can strongly enhance that dead zone by selling another call, then do that. At the money call or slightly out of the money call or whatever. But I would not, if I'm in a position and there's risk of me going into the dead zone on the last day, late in the afternoon, there's no way I'm going to hold on to it. Okay. I'm new and I'm starting review. When do you typically start putting on a new trade for either starting the bullish or bearish trades Thursday or Friday or the previous week, or typically doing this on Monday or next week? So you can actually go out. You can go out 2 weeks if you want. But the way I like to do it is when the market makes a significant move, then I put on a trade. Either to the downside or to the upside. And if the market has made a significant move to the downside, then I'm going to make it a more bullish trade. If the market made a significant move to the upside, like it has, then what I do is I put it on the bearish trade and I wait for a better trade for the bullish. You're welcome. Let's see. So I used IB for the charts, the spread chart. Is that trade is on the screen? Anthony, no, because you can't get into this trade the way that I'm getting into it without being willing to take the $350 risk. So what I'll do is well, so you can put on a similar trade, maybe, let's see, this is actually in the money right now. And so you can't quite get, you can see the time is already starting to tick off on this thing because the market's at 316.34 and I'm trading at a $1.34 credit. So if I were to put on this trade right now, I'd put it on at like 135-ish, and then I would go in here and I would put on a bearish trade, something like this, let me do this. I would do like a 321. Oops, didn't start a new one, so hang on 1 second. So we'll do this. Sell and a buy. So let's do a let's do a 321, 323. I know, let's do a 324, 322. So I would try and do 2 of these. 322, 324s, and it'll adjust here. You can get it for 63 cents. So I can do 2 of those for 63 cents a piece. That'll give me about $1.30. So I'll have a small credit, and then I will plan to sell a couple of 326s, and I'd sell them for maybe 50 cents. If I brought in 63 cents, then I would have a risk-free bullish trade at that point. So that's probably what I would do. And so let's see here. Why don't I go ahead and do that? So I'm going to do a copy of a copy of a copy. So let's just copy that one. And so I would do order number 1 at a 135 credit, and that'll probably get filled fairly quickly. And then order number 2, which would actually be order 4. And we'll go with 67 just to make sure we have a higher probability of getting filled. 0.67. I also don't like putting these on at the end of the day because you see price movement going on at the end of the day, and it can move away from your prices fairly quickly. All right, so now I've got a 1 to 2, and I will save that one. And I'll put it in that. All right. So we'll see. So that's what I would do with that particular trade. Okay. All right. Would the smart fill be a good way to get out of the profit zone if you're not at your computer all day? Correct. Yes, you could absolutely do that. You could say if the market moves to, let's say, the back of your profit zone, then you begin the process of getting out, or even the beginning of your profit zone, then you can begin the process of getting out using the smart fill. Absolutely, Ryan. Could you show the recommended trades again, sir? So here, let me. So it is 316, 319, 320. That's the bearish. And then I actually have the bullish being a 322, 324, a couple of those. 65 cents a piece is what it's going for. So far, I don't show being filled on my bearish yet. All right, so let's see here. All right, moving on. Thursday will be same time as usual, 2 o'clock Eastern. Bearish trades, you know, I don't waver from on the bearish trades too often. It's usually a very, very close variation to this, to what you see. And you know, here are the prices. For example, the prices that were available on Thursday for this same exact pattern. Right, short 304, short 307, long 308s. Credit of 312. This one was in the money significantly, so you can go at the money and slightly out of the money, and you can see that a week before. Oh, looks like I just got filled on both of them. All right. So I was filled on both of those trades just now. All right. Let's see. Okay, perfect. Mark, yeah, I answered that at the very beginning of the question session. Yes, that's a good move because you have a risk-free trade as long as your dead zone in your bullish trade is not wide. Have I thought about a button on trade partner that would import a constructed trade directly into risk profile in PDS? Yes, we are working on exactly that, and vice versa. There's an everyday. Oh, no. I said that eventually there will be an Tuesday and Thursday, and so I was watching the markets, and I figured there might be, you know, some opportunities based on every day being an expiration day. You know, Monday, Tuesday, Wednesday, and Thursday. But it wasn't It wasn't quite what I was expecting. Actually, I can't say it wasn't what I was expecting. It wasn't one that I'm going to confuse anybody with because it's irrelevant at this point. There would definitely need to be more of that happening before I go into that at this point. Once you find the bullish trade, what criteria do you find the bearish? So you take a pattern. You can be really simple. We were simple with a couple of patterns last week on the bearish, just simply by going short an at the money and long one that's 3 points out of the money, something like that. Let's see here. Do you ever close out short legs and bearish? Do I ever close out the short legs in the bearish with most of the value is lost? Yes. If there's also not very much value in the longs, that's absolutely something you can do. And you can sell the same strikes above. You just got to make sure that you're not opening yourself up to a massive debit on the trade because of your bullish trade. I kept getting exercise on my shorts as the market moved up about 5 points above. It's better to close the spreads that have shorts taking a significant loss. So, if the shorts are only 5 points in the money, they're usually not going to get assigned. Because there's still extrinsic value in those, right? So, for example, right now, the 710s, 311s are going for 675. That's still 35-40 cents of extrinsic value. And so, you're not gonna. I don't know. That's actually $1.35 extrinsic value. So it depends on how much shorts there are, or how much extrinsic value there is on those shorts. If you have a bearish and a bullish trade on, and the market is in one of their profit zones, do you exit one trade? So it totally depends on where it leaves me with the other trade. So if I have on a bullish trade and a bearish trade, and I exit my bearish trade at, let's say, a $50 profit, and now I have no more credit, but I have $150 of bullish debit in place. Now I have created risk to the downside of $100. And so the answer to that is no, unless you are able to account for the risk that is the extra risk that is created by the other side of the trade. What tool do you quickly use to see whether your trade is making profit at the moment? So I just watch my my smart trading files, and so if I got in at $1.35 and it's trading at $1.45, that shows me what profit I have. And we are making changes, by the way, not changes, but additions to Trade Partner that actually keep track of every spread that you place on, and so you don't lose the spread information. It actually keeps track of every spread that you place on. That's coming out soon. All right. Any other questions? We are now an hour and 50 minutes into this one, so probably should go ahead and end today's call. Looks like I got all the questions. Appreciate everybody coming on, and I will see you Thursday at 2 o'clock. Everyone have a wonderful day.